The Netflix collapse of more than 70% has left a lot of investors wondering if Wall Street is abandoning streaming services and other pandemic winners. Now, the big question is, should you look at the massive collapse of Netflix as a buying opportunity? And is this the last chance to buy the dip? In 12 minutes, I will answer these questions as well as give you an in-depth look at Netflix as an investment opportunity for the long run. Now, if you want to be among the 10% smartest who watch the whole video to the end, I can promise you very valuable insights, as our strategy bases itself heavily on short interests. If you don't know what that means, you definitely want to watch the whole video, as I'll give you all the details on this extremely powerful investment metric. Okay, let's dive in. Netflix is a dominant player in the media streaming services business. Since Netflix launched its streaming service back in 2007, the share has risen an astronomical 68,000% to a peak of $690 per share in November 2021. The stock rose a spectacular 39.7% annually until the peak in 2021. Growth in subscribers increased by 37.8% annually in the same period, until the sudden fall. Now, what was the reason behind this sudden drop? We'll go through the reasons you need to be aware of, but before we do that, let's start by looking at the competitor landscape. The streaming segment has dramatically changed. In the last few years, a number of competitors have emerged. Netflix has been joined by newcomers like Disney+, Amazon Prime, Apple TV+, and HBO Max, all taking their fair share of the market. It seems like the saturation of the market is well underway. Many have switched over to the newcomers. So, is Netflix doing something wrong? Netflix has been increasing its subscription price the last few years without adding any substantial benefits. The largest cost item for the streaming service seems to be the making of original content. The costs have rapidly increased from 2017. Since Netflix is the largest player in the streaming market, it is only natural that their annual spending on original content is well above the competitors, with $6 billion estimated to be spent in 2021. Netflix passed 2,400 original titles the same year and averaged just over one new original title every day in 2019. Yet the majority of the content has received little to no long-term cultural impact, according to data from Google Analytics. This begs the question, is Netflix's approach to publish quantity over quality? The newcomer Apple TV Plus has the polar opposite strategy. With fewer original titles in the library, yet the show and movies that have been released have gotten a great amount of good critique. As of today, there's low visibility of the profits and total numbers of paying members addressed in Apple's 4Q21 report, but estimations from Statista indicate that there are 25 million paying members on Apple TV Plus internationally, a remarkable growth since the launch in 2019. Despite the smaller content library, which in some sense is understandable as the platform has only been available for 2 years, the subscription fee is just $4.99. In early 2019, Netflix stated that they were more frightened of Fortnite and YouTube than the coming Apple TV Plus and Disney Plus. In hindsight, they clearly overlooked the competitor's potential. Okay, so recently the parabolic run of Netflix seems to have come to an end. The stock has basically collapsed and 70% of its value has been shaved off. So, what's the driver of this massive drop since November? We'll look at 3 reasons and potential risk factors you need to be aware of. First, COVID drove the growth in subscribers up as more stayed home. This boosted many stay-at-home stocks. Among them was Netflix. Looking back, many of these stocks saw an unrealistic and unhealthy rise that in retrospect was clearly unsustainable. So since the end of the pandemic, Netflix share price began to fall. Second, the triggering cause of the massive drop is the war between Ukraine and Russia. As Russia invaded Ukraine, many companies felt obligated to pull out of Russia to show their opposition to the Russian invasion. This affected the first quarter of 2022 as Netflix lost 700,000 subscribers from the withdrawal. This led the overall number of subscribers down by 200,000 quarter by quarter compared to the expected growth increase of 2.5 million. Third, tech segment is down across the board. Remember, we are in a very uncertain period now. Inflation rates are high. There are record high interest rates post-COVID. There is a war in Europe. power supply shortage, and as we've discussed, a lot of overvalued stocks as a result of the pandemic. This has led the Nasdaq index to fall a solid 24% this year alone. Netflix's own outlook predicts further loss in subscribers for the coming quarter, with 2 million fewer members. This is the first time Netflix has had a net loss in subscribers for over 10 years. Those news shocked Wall Street and resulted in $54 billion wiped off Netflix market cap overnight. Bill Ackman, a respected Wall Street investor, took a $400 million loss when he sold his stock in the midst of the crash. So, with such a big drop, shorting Netflix has definitely made some sense the last couple of months, but how is the short interest right now? And what does the short interest say about the stock prices in the coming months? Before I go into that, I will take you through a fundamental valuation of Netflix. We'll look at company performance, company debt, and profit margins. This is the Warren Buffett way of doing it, and we'll also calculate Netflix intrinsic value right now. One of the first things Warren Buffett always looks at is the company's performance. Return on equity, ROE, is a good metric to calculate this. Return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. Buffett looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. The higher a company's ROE percentage, the better. Currently, Netflix has an ROE of 32% compared to 19.2% of Paramount Global and 12.1% for Warner Bros. Discovery. The debt-to-equity ratio, D to E, is another key characteristic Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowed money. When it comes to debt to equity, you're looking for a low number. This is because total liabilities represents the numerator of the ratio. The more debt you have, the higher your ratio will be. A ratio of roughly 2 or 2.5% is considered good, but anything higher than that is considered unfavorable. Netflix now has a debt-to-equity ratio of 0.83. Now, the third thing Buffett would look at is a company's profit margin. A company's profitability depends not only on having a good profit margin, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. A high profit margin indicates that the company is executing its business well, but increasing margins means management has been successful at controlling expenses. Netflix currently has a profit margin of 20.3%. They have managed to increase it the last 5 years. Now, finding companies that meet these criteria is one thing, but determining whether they are undervalued is the most difficult part of value investing. To check this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals, including earnings, revenue, and assets. Once Buffett determines the intrinsic value of the company as a whole, he compares it to its current market capitalization, the current total worth, or price. Calculating the intrinsic value of a company is not a straightforward process, so we'll not go through that process in detail here, but based on our valuation, Netflix's intrinsic value of June 20th, 2022 is $364.62. This valuation is based on the model discounted cash flows. With a current stock value price of $175, we see 108% upside based on this valuation alone. Now, as I promised you in the beginning of this video, I said I would look at the short interest of Netflix and explain to you why it is an extremely powerful metric. But before I do that, I ask you to like this video because why not? Okay, so short interest is the number of shares that have been sold short but have not yet been covered or closed out. So why is this important? Well, the short interest can be seen as the indication of how much the overall market trusts the company's forecast as well as how they feel about the valuation of the company at that moment. And a downward trend in short interest indicates that fewer believe the price will go lower. As for Netflix, the short interest has been rapidly falling since the pandemic. This begs the question, if the Netflix stock has established a support level at around $180, the logical understanding of short interest seems to indicate that this is the case for Netflix. So, what do I think about the share price now? Is the dramatic fall of Netflix a market overreaction? Even after the 70% drop in share price since November, Netflix is up 14,000% since the listing in 2002, but in a shorter frame time of only 5 years, it is up 26%. Given my current fundamental valuation of the company, as well as the analysis of the short interest, the stock may have reached an agreeable price. From my point of view, this could be a lucrative investment even for risk-conscious investors, as long as you have a long-term perspective. We have to look at the bigger picture of the overall market, and what do I see? There are blood-red numbers across the tech world, but the underlying fundamentals of Netflix have not changed, which implies that Netflix has probably been dragged down excessively by the market. But the recent interest rate raised by the Fed and the overall negative trends in the market makes it difficult to predict. But as Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And remember, the share price of Netflix has fallen over 70% 2 times before. In addition, Netflix added 1.1 million new subscribers in Asia over the first quarter of 2022 and remains the biggest streaming company as of today when it comes to subscribers. But if you want to invest in this company, do your own research, as this is not financial advice. Now, as an intelligent investor, you want to know your risks and avoid mistakes. We have put together a video covering 10 investing mistakes that every investor should avoid according to Peter Lynch. See you over there.